Let's get one thing straight. Building wealth isn't about hitting home runs every day. It's about not striking out. Stay in the game long enough to take your shot when the pitch is right down the middle. My philosophy is simple. It's a three-part system. First, protect your capital base at all costs. This is your foundation. Without it, you're out of business. Losing money is the fastest way to stop making money. Rule number 1, never lose your starting stake. Forget the hype. Forget the noise. Protect what you have. Second, build a cash flow machine. Cash is king. Always has been, always will be. Cash gives you options. It pays your bills. It lets you sleep at night. Cash gives you the firepower to act when others are panicking. A portfolio that doesn't generate cash is a liability. It's just a number on a screen. I want assets that put money in my pocket month after month. This isn't about chasing a 10-bagger. It's about building a sustainable business that funds your life and future opportunities. Third, act decisively when the odds are overwhelmingly in your favor. This is the 10x part of the playbook. Most of the time, the market is a coin flip. You don't get paid for coin flip bets, but every so often the world gets crazy. Fear takes over. Everyone runs for the exit. That's your moment. Because you protected your base and built cash flow, you have the capital and courage to step in. Buy when there's blood in the streets. To run your portfolio like a business, you need control. You need levers you can pull. There are 5 of them. The first is your capital engine. This is how you generate cash outside of your investments. It's your job, your business, your side hustle. A strong capital engine is the most powerful tool you have. It lets you invest consistently without being forced to sell assets at the wrong time. If your income is weak, you're always on defense. Focus on increasing your earning power. That's your primary source of fuel. Don't ever forget that. The second lever is allocation. This is simply deciding where your money goes. How much goes into safe assets? How much into cash flow producers? How much into opportunistic bets? This is the single biggest determinant of your long-term results. Getting your big picture allocation right is far more important than picking the perfect stock. It's about building a structure that can withstand any storm. We'll break this down into a 3-layer blueprint later. Your allocation strategy is your game plan, written down before the game even starts. Third is regime awareness. The market isn't one single thing. It has seasons or regimes. Sometimes growth is strong and inflation is low. Sometimes inflation is raging and growth is weak. You don't use the same playbook in a blizzard that you use on a sunny day. Understanding the current economic regime helps you tilt your portfolio. It tells you what kinds of assets are likely to have a tailwind and which are likely to face a headwind. This isn't about predicting the future. It's about recognizing the present and adjusting accordingly. The last 2 levers are risk control and behavior. They are intertwined. Risk control is your set of non-negotiable rules. It's your brakes. Markets are chaotic, but we can simplify the chaos with a map. Think of the economy in 2 dimensions: growth, accelerating; growth, decelerating; inflation, rising; inflation, falling. This gives us a simple 4-quadrant map. You don't need a PhD in economics to use it. You just need to know which box we're in. Each regime favors different types of assets. Recognize the regime and tilt your sails. It's about playing probabilities, not certainty. Regime 1, high growth, low inflation. This is the Goldilocks zone. Own assets that benefit from strong growth. Stocks, growth companies, real estate. You can take a bit more risk, but don't get complacent. Regime 2, stagflation. Growth slows, costs rise, headwind for most stocks and bonds. Favor real assets and capital preservation. You're playing defense. Cash matters more. Regime 3, disinflation, deflation. Economy weak, prices stagnant. Safety and guaranteed income streams lead. Avoid cyclical stocks and low-quality credit. Your portfolio needs a structure, a blueprint. Mine is built in 3 layers. Each layer has one job. This structure provides stability and clarity. It stops you from mixing safe money with risk money. Layer 1, the base. Its only job is to survive. 12 to 24 months of essentials in cash and short-term bills. Non-negotiable. Cap it. Once full, fund the next layer. Sleep well. Layer 2, the cash flow engine. Generate consistent income, dividends, REITs, high-quality bonds, infrastructure, pay bills, reinvest the rest. Layer 3, the opportunistic sleeve, small capped, 5-15%, funded by excess or during crashes. You can only lose what's in this sleeve. If a bet goes to zero, your base and engine remain untouched. Every dollar has a job. The base protects, the engine funds, the sleeve adds upside. A business needs a regular meeting rhythm to stay on track. Your portfolio is no different. You are the CEO. Hold a weekly meeting with yourself. Keep it short, 20 minutes. Not obsessive price checking, a disciplined check-in. The agenda is simple. First, review your capital engine. Second, check your inputs. Did you pay yourself first? Automate it. Third, review your system. Are allocations within bands? Use your checklist. Scan for regime changes, growth and inflation. Same box or shifting? Note it. Process over outcome. Run it and move on. Rebalancing enforces allocation rules. Make rules simple and mechanical. Schedule it, not emotion. Every 6 or 12 months. Use thresholds. If a layer drifts 5% from target, act. Trim winners back to target. Route profits to your engine or base. Use new contributions to rebalance first. Write a crash deployment protocol before a crash. In panic, you won't think clearly. Follow your script. For every 10% market drop, deploy a set amount of cash, 20% down. Tertiaires deploy 25%, 30%, tertiaires 35%, 40%, tertiaires 40%. Predetermine what you'll buy. Turn fear into mechanical execution. Don't bet on just one horse or one country. Home bias is risky. Diversify globally to smooth returns and avoid single-point failure. Your risk code: never risk ruin. Cap single position loss. No core leverage. Always know your why. Your investment policy statement is where it all comes together. Write your philosophy. 3-layer targets. Rebalancing rules. Risk dials. Crash protocol. And behavioral scripts. Writing it down forces clarity. It's a contract with your future self. In panic, read and execute. Don't improvise. A plan is useless without action. Here's a 30-day sprint to go from zero to operational. Each week, one mission. Week 1. Calculate 12 months of essentials. Fund cash or short-term treasuries. Open accounts. Set transfers. Don't move on until done. Week 2. Define base engine opportunistic targets, e.g. 20, 65, 15. Write your IPS in detail. Week 3. Automate contributions every payday. Choose low-cost index funds and ETFs. Consistency beats genius. Week 4. Review aloud, tweak, sign, and execute initial funding. Schedule your weekly 20-minute CEO meeting. You now have a living, breathing system. You have a plan. You have a system. Now execute relentlessly. That's how you win.